Yes, sir.
Okay, good. So you're welcome back. Tonight we need to finish up what we started um, last week on IFRS 15. We started some application areas and we were explaining it, but we could not finish it up as fast as we should. So we're talking about the practical scenarios under IFRS 15, how you treat some specific transactions, looking at sales and right of return, warranty, principal versus agent, then consignment, bill and hold arrangement, and repurchase agreement. So we looked at sales and right of return, that this is one where the customer has right to return. And we said that the seller cannot recognize revenue until that period for which the customer has right of return has elapsed. So if it has not elapsed, you cannot recognize revenue. What you should recognize instead is a liability because the customer can return it. And as soon as that exists, then since you cannot recognize revenue, you should also transfer that inventory or the cost of sales, transfer it to an inventory recoverable account. Because these goods in question that you have transferred, you know that you will have purchased it and you have recorded it in purchases. So now that you cannot recognize it as sales, so you should not be in cost of sales too. So you take it out from cost of sales, you put it in inventory recoverable account. Then we looked at the question around that. Also is warranty. Warranty, there is a standard warranty or assurance related warranty, and there's also service related warranty. So there is usually this warranty that comes with a product that is there to say that we assure you that this product will perform up to specifications. So they come with the product, right? So the key accounting issue here is that those type of warranty are not separate performance obligation. They are dependent, they are not separately identifiable. So they are dependent on the main product itself. So what we do for those warranties is to make a provision that should in case we have to make some adjustment to the product should in case there is actually a damage on the product. So we need to make a provision for the cost of doing that. However, the one that relates to service related or extended warranty is that where the customer wants the product to do more, or they want to extend the warranty period, and in this case, the seller will have to charge extra for that. They will have to charge extra for that. So those type of warranty, you have to treat them as a separate performance obligation, and you need to allocate transaction price to them. Then we also looked at principal versus agent. So at any point in time, if you are acting as an agent, you are not supposed to recognize the entire amount collected. You should not recognize it as revenue. You that you are an agent, you should only recognize just your commission. And you should know that you are an agent where you are not the one that would execute the transaction. There's another party that will do that. You're not the one. And also, you're not the one setting the prices. You're not the one setting the prices. In fact, you don't even have inventory risk. That if there is a damaged good, it's not you that will suffer loss, it's another party. And you don't even have credit risk. If the customer does not pay, It's not you that will suffer. There's another person that will really suffer the loss, right? The only thing you can just lose might be your own cut, your commission, not the worth of the good itself. Then you are an agent, right? You are more like an agent. In fact, all these online platforms like Jumia, like Amazon, like all of that that facilitates connection between buyer and seller, they are just acting as an agent, right? They are not the core, they are not the seller. Or let's say Uber, for example. Uber cannot recognize the entire amount you pay as transport fare as revenue. No, they are just facilitating the transaction. They are agents. They are agents. So that needs to be identified. When you're an agent, you do not recognize the entire amount as revenue. We also mentioned consignments where you have a dealer or a distributor. So when you have a dealer or distributor and you transfer goods to your dealer or distributor, you cannot recognize, so that's not revenue. You cannot recognize revenue because you have not really transferred control to that person, especially where you can ask the dealer to return goods if he's unable to sell, right? And the dealer will not be able to pay you until he sells. The agreement is such that he will not pay until he has finally sold. But if it's that he pays, he can pay you. And whether he sell or not is none of your business. But if whether he sells or not is your business, you cannot recognize revenue. And even if he makes deposits and eventually is unable to sell those goods and he can request back for his deposit, you cannot recognize revenue in those arrangements. So that's more like a dealership or distributorship arrangement. Then there is bill and hold, where you sell goods, but the customer decides to leave the goods in your location at his own request. So the customer actually requested that let the goods remain in your place, most obviously because the customer does not have where he can place the goods. Now, the thing here is this. Uh, it therefore means that you are offering the customer additional service, even if you are not collecting money from the customer because of relationship. That does not undermine the fact that there is an extra service. There is an extra service because ordinarily you would have charged any other person warehousing service, warehousing fees. Okay, it's just because this person is your customer and you just decided to let go. But the substance of the transaction is that you are offering additional service. And in that wise, you need to allocate transaction price to that service as well. You need to allocate transaction price to it. So that was what we discussed. Then we started the purchase agreement before everyone got tired. So let me quickly finish it because it's a little, it requires some thinking like that. So let's pay attention. I want to finish this, then I'll mostly end the class for today. And maybe I'll just show you one. There's one thing I want to show you also, then I'll end the class. So let's see how fast we can conclude this. Now, please listen attentively and understand it very well. If you don't understand, ask questions. So, a purchase agreement, as the name implies, you transfer goods to a customer and you agree that you're going to repurchase the same goods after a certain period of time, that you're going to buy it back from the customer. So I told you last week that the key issue here is whether the seller has transferred control of the goods or services to the customer. That's the key accounting issue. Okay. So has it transferred goods? Has it not? Now, see, generally, anytime a repurchase agreement is present, it's always assumed that the seller has not transferred control. Yes, because the seller wants to repurchase. So on the surface, we say you have not transfer control because you want to repurchase. But standard says no, don't assume. Let's look at it deeper. So it could fall into any of these three forms. Number one, where the seller has an obligation to repurchase, obligation, we call that forward contract. Or the seller has a right to repurchase, we call that call option. Having a right and having an obligation are two different things, like hugely different, because having an obligation to repurchase means that you cannot say you don't want to, you have to, you must repurchase. But having a right to, I mean, you could decide not to. It's not compulsion. You could decide not to repurchase. So that's majorly the difference. Then finally is looking at it from the customer perspective, where the customer has right to request for repurchase. We call that put option. So they could give you scenarios in the exam around this. Now, how do we treat each of this? I started with forward contract last week. I told you that here, the seller has an obligation that is under compulsion to repurchase and he cannot refuse. So in this case, it means the seller has not transferred control of the goods or service. So revenue cannot be recognized. Rather, what he recognizes is either a financing arrangement or a lease arrangement. Because he must repurchase. So the substance is that you did not sell, you have not transferred control. The risk you have not transferred, the reward you have not transferred. It's still with you as a seller. So you cannot recognize revenue. So it's either a financing arrangement or a lease. So how would you know? So it is a financing arrangement if the repurchase price is higher than the original selling price. So how do I know? Because if you are paying much more later, much later, it therefore means that you are paying back the loan plus interest. That's why the repurchase is higher. You're paying back the loan plus interest. That's how I know. Anytime I see that the purchase price is higher, then I can easily guess that this is a loan arrangement, that you are paying back the principal and the interest. Also, it is a lease arrangement where the reverse is the case, where the lease arrangement is lower. Okay, so in this case, we are seeing it as if the seller just collected the goods from you. The money he gave you was like a deposit, which you are going to pay him back some of it, like that. So he just wants to use the goods or the asset temporarily. So the differential is what you are going to recognize as an income, as the lease income. So where the purchase price is lower than the original selling price, right? It therefore means that you are going to make a margin on how much the person gave you. So that margin you're making is like your own income. So let's look at scenarios. So we looked at two scenarios already. The first scenario, I looked at a scenario where the contract requires entity A to repurchase. So it's a forward contract because it has to repurchase. And in this case, the repurchase price is higher. You see, the repurchase price is 120,000. The original selling price is 100,000. So this clearly is a financing arrangement. It's a financing arrangement. So that 100,000 that you collected, it will be treated as a loan. The 120K, like the repayment of the loan. The excess of 20 is the interest. That will be recognized as interest. And I showed you the double entry last week for each level: the loan, the initial 100,000, the interest that will be recognized over the period of the transaction, then the repayments. the repayment. So the interest is like the excess of the purchase price over the original selling price. Now look at another scenario where we sold for 500, and this one was very specific that the contract includes a forward agreement requiring entity B to repurchase after 4 years for 450. In this case, you see that the repurchase price is lower. Okay, so imagine that you sold an item for 500. You collected 500. So after 4 years, you are not going to pay back 450, right? So effectively, it's like you have made 50,000. So that 50,000, that is your real income. So you can recognize income in that case. You recognize a lease income, but you won't recognize it just in year one, but over the period of the lease, in this case, over 4 years. Over 4 years. So we solved this one also last week. That we're going to recognize 50K over 4 years. Then scenario C was when I discharged you guys because I was asking you a question and I saw that nobody could follow. I said, okay, let's continue. So for scenario C, is sold goods for 2 million. The contract includes a forward agreement requiring entity C to repurchase for 2.5. Even without thinking, based on my explanation, this is a financing arrangement and the repurchase price is higher than the original selling price. Okay, so the 2 million is a loan. There is an interest of 500. The 2.5 is like the repayment of the loan. This extra 2 million, sorry, this amount recognized by the company, by the director is wrong. You cannot recognize revenues. It's a wrong treatment. They need uh, to recognize it. So clearly, this is a forward contract. This is a forward contract. And the repurchase price is higher than the original selling price, which shows that it is a financing arrangement. The 2 million will be recognized as a loan. The 500K will be recognized as interest over the 4 years. The 2.5 million will be recognized as a payment of loan. Okay. This is the solution. Okay, so that's for forward contracts. So when we have forward contracts, that is where the seller must repurchase. So in that case, there is never a sale. So it is either you have a financing arrangement or a lease arrangement. And whenever the repurchase price is higher, that's a financing arrangement. Whenever the repurchase price is lower, that is a lease arrangement. Then the second one is call option. So here, the seller has the right to repurchase. So since it is the seller that has the right, it therefore means that the seller has not Transferred control. See, you still have the right to repurchase. I mean, he has not transferred. We cannot work with his mind. Since he can decide that, okay, even though it's not compulsory, but he can still say, I want to repurchase. We cannot recognize that as revenue. No, 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 we can't. So this is rarely, rarely recognized as revenue, which therefore means that in some way you can find a scenario where they might be recognized as revenue, but it's very scarce. So it's rarely. So it is either recognized as a financing arrangement or a lease arrangement. So just the same thing like I taught you here. Same. No difference. The same. I'll just copy and paste it here for you. Same thing. So it is a financing arrangement. If the purchase price is higher, it is a lease arrangement if the purchase price is lower. However, this one is, you will hardly find it. However, but let's just put it in rare cases where the expected market value. So they will give you an expected market value that will have been determined from the inception of the purchase agreement. Okay, where the expected market value is given, and that expected market value, it is when you compare it with the purchase price that the seller will have to pay, that market value is much higher than it. It's high. It's high. Ah, just imagine there is an asset that you're supposed to repurchase for 40,000 naira, and you expect the market value of that asset when you want to repurchase it to be like 100,000. That is what the expected market value would be. Would you have the intention to want to repurchase? Yes, you will, because you know that you are going to be repurchasing an asset that is worth 100,000 for 40. So there is a significant incentive to repurchase from the side of that seller. He would want to repurchase because it pays him to. So where the expected market value is given and it is higher than the purchase price. Okay, this shows that, oh no, yes, so the interpretation is right, but in this third case, what you see the examiner give you is where the purchase price, the expected market price is now lower. If the examiner wants it to be a sale, if I follow through with that, so it's either a finance arrangement or this. But if the examiner wants it to be a sale, they'll do it in such that the expected market value is lower than the repurchase price. In that case, the seller he will not even exercise that option at all. So this shows that the seller does not have a significant incentive to repurchase. So to then be recognized as revenue. So this is rare in exam because even the standard mentioned it that most call option, we expect it to be that the seller has not transferred control and there is no sale. But if this situation arises and the expected market value is significant, is lower, then it shows that the seller will not likely um, wants to repurchase. Then we can recognize the seller can recognize it as revenue. Okay, so that's a call option. Fashit, I can see you and please ask a question.
So I wanted to just confirm that in this scenario, the company that is the seller, like the company preparing the financial statements is the seller in this scenario.
Yes, yes.
Thank you, sir.
You're welcome. Okay, let's look at some scenarios. A, entity A sells equipment to a customer for 100,000 on 1st January 2005. The contract gives entity A the option to repurchase the equipment after 3 years for 60,000 required. Explain how entity A should account for this transaction. So in this case now, you see that um, they did not require entity A to repurchase, but entity A just it just gives the contract gives him the option that okay, if you want to repurchase, that's what we call option. It's different from a forward contract where he must. Where he must. This one he must not is a right. You have the right if you want to. Okay. So in this case now, this is a call option in this case, and you see that the purchase price is lower than what? The original selling price. Okay. Fashion, is this a financing arrangement or a lease arrangement?
Is not a financing arrangement, is a lease arrangement.
Okay, that's correct. So this is a lease arrangement. This is a lease arrangement. So how much lease income will be recognized over the 3 years?
40,000.
Okay, that's correct. So we recognize a lease income of 40,000 over the 4 years, over the 3 years. Don't worry. So let me just stress you guys a bit. The examiner will not really ask you this. This is what you need to note that I've stated. So let me just stress you a little bit. Now, this 100,000 that he receives when he sold the assets, how will you recognize it? So what will be the journal for that?
Uh, Credit inventory recoverable and debit inventory. No, 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 sorry. The other way around. Credit inventory and debit inventory recoverable.
No. So you know that he receives money, so you need to debit bank first. You need to debit bank first. So then he doesn't need to touch his inventory. Inventory remains intact. Nothing is touching because We have demonstrated that it hasn't transferred control, so leave your inventory the way it is. Don't touch it because the goods is still coming back. So um, you credit like a liability. You can call it contract liability. That is what you do because you collected money, you debit bank, you credit a contract liability. So you see this lease income of 40,000 over the over the 3 years. So this is the one where you'll be using to credit you'll be debiting P&L every year. Say debiting P&L. You'll be crediting P&L every year as lease income every year, and you'll be debiting the liability. Just so that after 3 years, this 100,000 liability will now becomes it will now be 60,000 since you'll be debiting this 40,000 over you spread it over 3 years. Um, you probably use an effective interest rate or something like that. But by the time you debit it small with over the 3 years, 40 minus 100 is 60. So the balance of that liability will be 60. So by the time you are paying this back, you just credit bank, you debit the contract liability with that 60, all the account closes out. Okay. So I'm just mentioning it for knowledge sake, right? So you can have that, but the major thing here is for you to identify that it is a call option, it is a lease arrangement, and the difference is what we recognize as income, lease income, recognize a lease income over the lease term. Now, scenario B is where entity B sells machinery for 500,000 on 1st January 2005. Entity B has the option to repurchase the machinery after 4 years for 550. Explain the appropriate accounting treatment here. So
Sir,
this,
sorry to draw you back. For the treatment of the 40,000, you said I just because I didn't write it immediately, so I don't want to forget. You said debit lease income and credit
no, you credit
contract.
lease income. But
Okay,
you credit lease income as to P&L. In fact, credit P&L, lease
okay.
income, debit the contract liability.
Thank you, sir.
Not the entire 40,000. It will be small over the 3 years.
Okay.
You spread it. So when I teach IFRS 16, you really understand that spread. There's something we call interest rate implicit in the lease. So you take a percentage of that. That is what you use to spread your lease rentals over the entire period and all of that. So now in this case, this is a call option. And in this case, the purchase price is higher than the what? Than the original selling price. So is this a lease arrangement or a finance arrangement?
Finance arrangement.
Good. So this is a financing arrangement. Okay. So again, the interest income of 50,000 will be recognized to here over the 4 years.
Sir, sorry, is it interest income? What I'm asking is because like when the repurchase price was lower, it was lease
And
income.
this is interest expense. because he's the one that will be paying interest. He's the one that is paying. So it's not an income. So that's really what I want you to know. So in this case now, like we have mentioned before, the 500K received will be recognized as loan. Can you, who can, if I say it, can you tell me the double entry for that?
So, the interest expense, okay, for the 500 K loan received, that we recognize, we
Yes.
would debit, we will debit, sorry, we will credit contract liability or loan,
Okay. Loan is better.
and uh, we credit loan, and we will now debit um bank, because the money is still coming in to the
That's
bank
correct.
account. Okay.
That's correct. That's correct. What about the expense that is recognized to P&L over the 4 years? How would you do that?
Okay. So we'll recognize it gradually, like how we did the lease income. So what we'll do is to debit P or L
Okay.
with interest expense and credit the, if we debit P or L, we'll credit the loan because it will increase. Yes, should increase it. Yes.
That's correct. Absolutely correct. And finally, the 550,000 be recognized as what? As a repayment of loan. So what will be the double entry for this?
That is, this is like when it has been completely, like after the time has lapsed. So we would debit contract liability and now uh, credit bank.
Correct. Not credit bank. Correct. Okay, so it's good that you know the double entry is so good. It's so good, but the thing is that the exam does not really ask those double entry per se. So they just need you. They just always assume you know. Okay, it's assumed that you know. So these are the substance that you should note how each of them are treated. The 50,000 is interest recognized over 4 years. The 500,000 is a loan. The 550 is a repayment of that loan plus interests. Plus interests. So the final scenario here. So entity C sell specialized equipment for 2 million. It has the option to repurchase the equipment after 5 years for 2.3 million. The estimated market value at that date is 1.5 million. The purchase, the guy recognized revenue immediately. Require discuss whether the accounting treatment is appropriate. Okay, so in this case, we are given an expected market value. So first is that this is a call option. Okay, and when you're given expected market value, so you do that comparison first if you are given. So the expected market value, you do it against the repurchase price. The purchase price is 2.3 million. The expected market value is lower. So the expected market value of 1.5 million is lower than the purchase price, which shows that the seller, okay, let me give you opportunity to talk. In this case, does the seller have a significant incentive to exercise, or it does not have a significant incentive to exercise, and why? Who can explain that to us?
uh, the seller will not want to the person will not want to exercise their right to sell because they will be
Repurchase.
paying more
You know to sell.
to repurchase. Sorry,
Yeah,
they will not want to exercise their right to repurchase because they will be paying more to buy the same asset instead of going to the market.
that's correct. That's correct. So why will he want to pay 2.3 million where he can buy the same thing for 1.5? He will not, he's not going to exercise that option. The seller has no significant incentive to purchase. Hence, control has been transferred and the seller, who is entity C, should recognize revenue of 2 million. Hence, the accounting treatment by entity C is appropriate. So, like I told you, this is where this is. I just want to mention it just for mentioning sake, just so that you would know every part of it in case. So if you are given the expected market value, you do that check first. You check it that does this guy have incentive to repurchase? If he does not, then don't. That means he will not sell. That means he will not repurchase. I mean, so he will just have recognized the item as revenue because he knows that he's not repurchasing. There is no incentive to do that. So that's that. So the final one is put option. Okay. This is where the customer has the right to request the seller to repurchase. So now this has nothing to do with the seller. So here now it is assumed that the seller has transferred control because he doesn't have the mind to repurchase. He doesn't have the mindset to repurchase because he has sold. But in the agreement is the seller, is the customer that can request a repurchase. Okay. So it's assumed that control has transferred. Again, where fact, let me put it like this. So we need to determine from the inception whether the customer will exercise the option or not. Okay. And this is determined by identifying the existence of significant economic incentives to the customer. So there is significant economic incentive to the customer where the expected market value is higher, where the expected market value as far as the customer, which one we paying? It will be paying for him to collect more money than the market value. Abi, that's where there is significant economic incentive. So where is lower than, yes, now, the
Yes, sir.
repurchase price. Where is lower? So it will pay him that I'm collecting more money then than the market. Something that in the market is 20 naira. Somebody says he wants to give you 15 naira. So you jump at it because it pays you as a customer to collect it back, to release the asset and collect that money. So there is economic incentive where the expected market value is lower than the repurchase price. So afterwards, we will determine whether, okay, which shows that the customer will exercise the option and transfer the assets to the seller. So control has not been transferred. So we will have identified that control have not been transferred. So afterwards, we will then determine whether it's a financing arrangement or lease arrangements using the same principle as under call option and forward contracts. Meaning that where the repurchase price is higher, then is a loan, but where it is lower, then it's a lease. I mean, from the perspective of that's how the seller is going to recognize it in his books. So, and the reverse is the case, meaning where the expected market value is higher than the repurchase price, it means that there is no significant incentive for to the customer, and hence the customer would not be willing to transfer the assets. We'll just continue to use it because the market value is much higher than what the seller is offering. And in that case, the seller should just recognize revenue for such an asset. So if you look at this first scenario, entity A sells equipment to a customer for 100,000 on 4th January 2005. The customer has the right to require entity A to repurchase. The customer, after 3 years, to repurchase the equipment after 3 years for 90,000. The expected market value of the equipment after 3 years is 40,000. So explain how entity A should account for this. Okay, again, all we need, the first check you do is to compare the expected market value with the repurchase price. In this case, is there a significant incentive here or not? ṣe ìtàn.
Yes, there is because he would sell it for higher than the market value.
Because the market value is 40,000
Yes.
and is going to get 90,000. So there is significant incentive here. So first is that this is a put option. It's a put option and the expected market value is lower here. It's lower than the purchase price. So there is a significant incentive for the customer to sell the assets. He will sell it much higher than market. So he would jump at it here. So now we have identified that. So hence control has not been transferred by the seller. He hasn't transferred control and cannot recognize revenue. Okay? And cannot recognize revenue. Now, furthermore, we need to then check whether it's a financing arrangement or a loan by comparing the purchase price with the original selling price. The purchase price here is what? Is lower than the
100 is lower
original,
than the purchase.
selling price. Okay. Hence, is this a loan or a lease arrangement?
Lease arrangements.
It is a lease arrangement. So how much would the seller recognize as lease income?
10,000.
As lease income over how many years? Over
3
3 years.
years.
So we had already analyzed this before now. So another one, entity B sells machinery for 50,000. The customer has the right to require entity B to repurchase the machinery after 4 years for 200,000. The expected market value at that date is 300,000. Again, here is the customer that has the right to require a purchase. So this is a put option. This is a put option. And first, we'll compare the expected market value is higher here, higher than
Sorry, is it, will you want to sell
here.
when you can? Yes, when you can sell for higher in the market instead
You
of
will not,
selling
you will not
to
sell.
the to entity B.
You will not sell now. You will not sell.
Oh, sorry.
You will not sell. So there is no significant economic incentive for the customer to sell. Hence, the seller has transferred control and should recognize the how much? The 500,000 received
Revenue. So yeah, you can go ahead and recognize revenue. Okay, so that's the end of IFRS 15. So you need to revise this because I see them asking that part. They can ask any of the parts that we have mentioned, but they ask it often in your exam. So I just want to show you some questions. I will give you opportunity to attempt it yourself, but let's just look at it together. So look at this question. Yeah, uh, they said that Kappa prepares financial statements to 30th September each year. During the year ended 30th September 2015, Kappa entered into the following transactions. Number one, on 4th September 2015, Kappa sold a machine to a customer. So Kappa also agreed to service the machine for a 2 year period from 1st September 2015 for no additional charge. The total amount payable by the customer for this arrangement was agreed to be 800,000 if the customer paid in 2015, 810 if the customer paid by January 2016, 820 if the customer paid by 28 February 2016. The directors of Kappa consider that it is highly probable the customer will pay for the product in January, which is this date. In January 2016, the standalone selling price of the machine was 700,000, and Kappa would normally expect to receive 140,000 in consideration for providing 2 years servicing of the machine. The alternative amounts received are to be treated as a variable amount. Okay, so these are the type of questions that you would find in your exam. So let me see the requirement. He said, explain and show how the transactions will be reported. So here now, how do we report this transaction? How do you report this transaction? Let me see. So how do you report this transaction now? So where we sold the machine and we are going to give it 2 years for him to service. We are going to provide 2 years free maintenance, 2 years period of service for the customer for no additional charge. So these are the price, these are the possible prices. But we're told that the customer will pay for the product in January. So that means that we will sell the commodity to the customer for 810. Now, the machine itself, if we were selling it without this 2 years, 2 year period servicing, we will have actually sold it for 700. And we will have the amount we charge for maintenance to provide this service for 2 years is actually 140K. Okay, it's 140. So, but yeah, we decided to collect 810.
for the bundle, for the bundle. Now, what do we do here? What do we do in this case? What we do in this case is that we have identified that this, even though we're selling machine and we are giving 2 years service for free, they are actually different or separate performance obligation because each of them have a standalone selling price. Therefore, we will need to allocate this 810,000. We will need to allocate it between the machine and the service. So we need to share this 810 based on their standalone selling prices. I've shown you that before. I've shown you how to do it. So I need you to allocate this. So let me note it for you. So do it. Of course, I'll share the correction with you. I've already told you what to do. So just make sure you allocate the 810, allocate it based on this, so that you then tell us how much revenue will be recognized, how much of this 810 will be recognized as revenue for machine, and how much of these will be recognized as revenue for the servicing. Now, the second one, on 20th September 2015, Kappa sold 100 identical items to a customer for 2,000 naira each. The item cost Kappa 1,600 each to manufacture. The terms of the sale is that the customer has the right to return the goods for a full refund within 3 months. After the 3 months period has expired, the customer can no longer return the goods, and the payment becomes immediately due. And Kappa has entered into transactions of this type with this customer previously and can reliably estimate that 4% of the product are likely to be returned within 3 months. Okay, I think this is even more straightforward. So this sales and right of return, and the portion, anyone that the customer can return, we would not recognize revenue, rather we recognize a refund liability. And now, since they have told us that 4% can be returned, so that means 4% of these goods, of this 100 times 2,000, 4% of it will be recognized as a refund liability, while the remaining 90% will be recognized as revenue. Now, the same thing applies to the costs. 4% of this cost, of this 16 times 100, would be recognized under inventory recoverable. We'll take that out from cost of sales. While the remaining 19%, leave it in cost of sales. And that is all. That is all. So you know how much you're recognizing as revenue, how much as refund liability, how much as cost of sales, how much as inventory recoverable. So attempt these questions in writing for me. Now, another one. He said IFRS 15 revenue from contract with customers was issued in September 2015 and applies to accounting periods beginning on or after January 2018. IFRS 15 replaces IAS 11 and IAS 18. IFRS 15 contains principles which underpin timing of the recognition of revenue from contract with customers and the measurement of that revenue required. Explain the principle underpinning timing of revenue recognition and the measurement of that revenue, which are outlined in IFRS 15. Are required to provide examples of. Okay, well, this is a theoretical question. So the principle of timing in terms of when do you recognize revenue? So the principle here is that where it talks about recognizing revenue either at a point in time or over time, depending on whether the service is rendered immediately or the service is rendered over time. So this is more of the step 5 that speaks to recognition of revenue. So if a service delivered immediately, then revenue is recognized immediately at a point in time. But if the service rendered over time, revenue will also be recognized. So that's the principle underpinning timing there. The principle underpinning measurements is step 3 that talks about determination of transaction price. So revenue are measured using the transaction price. Okay. And this transaction price can either be fixed, variable, and it ultimately can be non-cash consideration, and it is also determined by time value of money. Okay. So you just need you to speak around that, like that, just to know that you understand the steps in revenue recognition. Okay. Now, this is another one that you can also try your hands on. So this is talking about sales and right of return. Okay. It's similar to the one we have talked about. You can look at it. And if you attempt it, I would share the solution with you. Okay, if you read it, it's the same. The customer can return, then you don't recognize that portion as revenue until that period elapses. Okay. And the cost of sales also, you will take it out from there and go and put it in inventory recoverable, like that. So, and this B part, yeah, it looks long, but it's even easier than this one, because here the seller is giving a discount and is telling them that if you buy within if you buy certain quantity, I would sell it for you at a lower price. But if you don't, I will not. So if you look at it, it says on 4th January 2006, Delta began an arrangement to sell goods to third party. Entity B, the price of the goods is 100 naira per unit for all sales in the 2 years ending 2017. However, if sales of the product to this customer exceeds 60,000 in 2 years, in the 2 years ending 2007, then all the selling price of all units is retrospectively set at 90. So you see, so if the customer should buy goods of over 260,000 cumulatively over 2 years, so all the goods that he will buy going forward, including the one he has bought, he will sell it for 90, meaning that he might be returning some money back to the customer. Okay. So it now says that sales of the item to entity B in 9 months period total just 20,000, and this volume of sales per month was not expected to change before 2000. Okay, so that means that at the end of year 1, at the end of 2006, um, based on the estimate given, the customer has only bought 20,000. So that means you will recognize, I will recognize revenue at 20,000 times 100 naira, because the guy has not bought up to 60,000. So I cannot sell at 90 for the cost to the customer. And I said, however, in the year ended 30 September 2007, the total sales of the goods to entity B were 35,000. And based on current orders from entity B, the estimate was revised. So the director estimated that the total sales of the goods to entity B in the 2 years ending will be more than, okay, so that means in 2007 now, they have seen that, this guy has already bought 35,000. And on that basis, they believe that the he would buy more than 60. So he would get that discount. So that means for 2007, this 35,000 that we have sold, we will not recognize it as 100 naira, we recognize it as 90 naira because we'll sell to him at 90 naira. And additionally, the ones we have sold to him before at 100 naira, okay, we would reduce it from our revenue. Okay, we reduce that's 10 naira on 20,000 will be reduced from our revenue in 2007 to get what our revenue would actually be at the end of 2007 because it would meet up with the discount agreement like that. So there's another one here. This one, they say that you are the accountant of Oriente PLC that prepares consolidated financial statements. Your managing director, who is not versatile in accounting, has recently attended a seminar at which key financial reporting issues were discussed. Remembers being told the following: financial statement of an entity should reflect the substance of its transactions, revenue from contract to customer, should only be recognized when certain conditions have been satisfied. Transfer of legal ownership to the customer is not necessarily sufficient for an organization to recognize revenue from their sale. The reporting date of Oriente is July 31st. In the year July 31st, 2020, the company entered the following transactions. How many transactions? Two. The A part is just conditions that need to be satisfied before revenue can be recognized. You should support your answer with reference to IFRS. So this one, condition that need to be satisfied before revenue can be satisfied. So that one, you probably be discussing those 5 steps here before you can recognize revenue. And B, discuss how the transaction described above will be dealt with in the consolidated financial statement of Oriente PLC for the year ended July 31st, 2020. So what's the transaction we're talking about? It says that on August 1st, 2019, Oriente PLC sold one of its branches to Danto PLC for 24 million. The net assets of the branch in the financial statement of Oriente PLC immediately before the sale was 21 million. Danto PLC is a subsidiary of a bank and was specifically incorporated to carry out the purchase. It has no other business operations. Danto PLC received the 24 million to finance this projection from its parent in the form of a loan. Oriente continues to control the operations of the branch and receives an annual operating fee from Danto. The annual fee equates the operating profit of the branch for the 12 months, less the interest payable on the loan taken out by Danto for the 12 months to the previous July 31st. If this amount is negative, Oriente must pay the negative to Danto. Any payment to by Oriente must be made by August 31st, following the end of the relevant period. In the year to July 31st, 2020, the branch made an operating profit of 6 million Interest payable by down to 2 on the loan for this period was 2.4 million. So what do we do about this? What do we do about this? So the key thing here, since it's talking about revenue, is the fact that there is this company called Oriente that sold one of his branch to this company, Danto. And from all the information given to us, we saw that this Danto is not even an existing company. They just formed it. Is a subsidiary of the bank. So they just formed it specifically just to buy that those branches. They just formed it to just to buy those branches. So, and even the money itself, it was the bank that gave it the loan. Okay. So, but you say you have sold, but you still control, Orete still control operations of the branch. He now does it in a way that they are giving him a fee. They are giving him a fee, less the interest payable on the loan taken out by Danto. So from all of this, the key thing is that the sale of the branches is clearly seen that control has not been transferred because Orente still controls the branches, still the one that still manages the operations of the branch. Even though they are paying him money for that, but he's still the one managing the operation. So he would he cannot recognize sale in this case, and the branch will still remain in his books. He will still continue to report on them and all that because IFRS 15 will not allow this as a sale. And finally, for tonight is transaction 2. It says on February 1st, 2020, Authentic PLC sold the property to a bank for 15 million. So you guys should listen to this. I need one of you to attend to this. On February 1st, 2020, Authentic sold the property to a bank for 15 million. The market value of the property at the date of the sale was 30 million. Okay. Authentic PLC continues to occupy the property rent-free. Authentic has the option to buy. Okay. The property back from the bank at the end of every month from February until January 2025. Authentic has not yet exercised this option. The purchase price will be 15 million plus 150,000 for every complete month that has elapsed from the date of sale to the date of repurchase. The bank cannot require Authentic to repurchase the property until the agreement lapses after January 31st, 2025. The directors of Authentic expects the property prices to rise at around 5% each year. Okay, who can tell me very quickly, does this qualify as a sale, and what is this? What's this talking about?
This is talking about put option with for like or orientate to either buy from the bank at the end of the period or to not buy from the bank. It has the right to buy or to not buy from the bank at the end of the period.
Is oriented the seller or the customer?
The customer,
No.
sorry, is the seller, but as yes, it is the seller, but has the right to repurchase the assets from the bank.
Okay, so is this a forward contract, a put option, or a call option?
It is a has the right to purchase, to repurchase as a seller. Is a Put option.
The call
No, call.
option. Yeah, the call option. So the put option is where the customer has the right to request for repurchase. Okay, good. So now they gave us expected market value here, Abi? So is from the expected market value, will Otente repurchase? Is there any significant incentive here?
The market value at the date of sale is 30 million. But if if they should rebuy it, if they should repurchase it from the bank, it will be 15 plus 150.
So it makes sense for him to repurchase it because
Yes.
it
But
makes
I
sense.
am not sure because like I don't know how many months like
Uh,
this 150 will be.
I know that we are talking about 2020 now. So it makes sense for him I mean, based on the information at hand now, is he has the option to repurchase it from 2020, February 2020 until. So if we can quickly do it, this one will not be high. So
Mm.
yeah, yeah, it shows that he has not transferred control. So the
Yes.
issue, so you cannot recognize sale at all. Now, that is not the end. It's just to clear out that now that we know that he has not transferred control, then it's either a financing arrangement or a lease. So which one is this now? Is it a financing arrangement or a lease?
Mm. Since he can buy it now and he has the incentive to repurchase it now at a lower price, it will be a lease option.
No, 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 no. So
Mm.
for lease now, all you just need to do is just compare the repurchase price with the original selling price and check which is higher.
Oh, okay. Sorry. So it will be the 15 plus 150 compared to
Mm.
the 15 million.
Yeah,
Okay. So that means is a financing arrangement because
exactly.
the repurchase price is higher.
Exactly. So that means that this 15 million is a loan. The 150,000 every month is interest. So you will recognize interest from February till July. That's February, March, April, May, June, July. 6 months interest. While this one will be repayment for payment for the loan. Okay, so that's the end for IFRS 15. Just take your time and read these things to understand very well and see where it can help you. So let's stop here for tonight. On Friday, hopefully we'll be able to have class on Friday. I want to start IFRS 2 with you guys, share-based payments on Friday. So I know I can't finish it tomorrow, but if I can finish it next week, Wednesday, that would be nice. So that we can also cover IAS 19 on employee benefits. So if you can cover that next week, then so that we group account, can move to group account. So if we're able to finish group account in March, then what we're going to have is just very little things. And what is helping you guys greatly, what is helping you is that Sunday classes that you're joining is really giving us a lot of advantage and it's making our weekdays classes easier. If you were doing just these 2 days, it would have been very difficult for us to move as far as we should. Okay, So let's stop here for tonight. Go and try to revise this area, is especially this repurchase agreement. Is a little require some thinking and some revision and revision again. And try to look at these past questions. Try to write something down and share with me so I can share the solution with you. But I really need you to sit down and think and write it out. It will really help you because this part of your syllabus is um, you can easily fetch you some marks and you find it there often in your exam. All right. So I'll see you guys on Friday. Yeah, bye for now.